some topic. So from previous class, we were able to discuss about your yesterday high, weekly high, and all those stuff. So in today's class, also we talked about key zones in the previous class. One thing you should do for me is this: any class or any teaching that we undergo, try to what backtest it. Use the remaining week to backtest what we thought. If we talk about key zone, now open your charts. When we talk about key zone, open your chart, then you mark out those key zone, or if you have the indicator for key zone, you mark it out. Then you go on in what backtesting how price is reacting based on those key zone. How price is reacting based on those London manipulation, New York manipulation key zone, or the main key zone. So you backtest them. They are very, very important. We talk about resistance support. You backtest them, despite the fact that you have known them before, but backtest them to see how powerful they are. Anything we teach, backtest them, backtest them. Today we have been talking about Asian range, central bank daily range. We talk about them. Now, what you have to do is what you backtest them. You backtest what? You backtest them. So the first thing that we talk about today is what we call daily opening of what a price. We have weekly opening, we have monthly opening, we have daily opening. So each of them has what a role they plays when we're talking about what our daily cycle. Each of them has what a role they play what in this market. Each of them, each of them has what a role they play in market. So it's very, very what important. It's very, very important. And when we're talking about supply and demand, we use supply and demand to know our point of what interest. Though we use it in line with volume. So if price will basically say from here, volume will tell us that there's what a demand zone here. Then we mark this zone as what our demand zone when we're talking about demand and supply. So that is that. In market, we have what we call double top, triple top, and other stops. We have those double top, double bottom, triple top, and triple bottom. So whenever you see those things, double top, they act as what a liquidity tool. They act as what liquidity. Now swing highs and swing lows are what liquidity. They are what liquidity. Now today we'll be using M15, that is 15 minutes time frame, in explaining our daily opening. So today open as what OO in this GMT plus one, which is this area. This is the area that market would open. This is the area that market would open. So market open around this area. Then after that, market came sweep above it, above the opening of the price of that day, of today, before what going lower. We have today's what opening, which is this place. Same thing happens to what yesterday, that is on Friday, the opening of what Friday market, which is this area. So market sweep it below, sweep it above, then continue ranging. Continue ranging. Those that are advanced in market, I have a friend, his name is Steve Josh. On this EU, on this GU, on this GU, he can what see everything that is happening within what price, or even catch most of this move. Though I do that before, but I don't do that again. So someone said this. So that is that. So we have what we call daily opening. This is the day, today's, that is on Friday's opening. The opening of that what of that day. This is the opening of that day. This is the opening of that day. Now after daily opening, we have what we call Asian session. Asian session start from what? 1. Asian session start from what? 1, which is this place. You start from here. From here to 6 a.m. in the morning in GMT plus 1 to 6 a.m. This is what Asian session. The price range within this session. And the law that abide in what that cover this what Asian session is this. One of them is that it must not be what more than 30 pips. The pips range must not be what more than 30 pips. We won't be using it. We use it as what a confluence. We use it as a confluence. This is what 11 pips as the range. So one standard deviation means the same size of this what of this rectangle box here. We move it to the upside or to the downside in calculating the what the standard deviation, either 2 or 3, to know the what the manipulation of that day before the true move. To note the what manipulation of that day before the true move. So now let's say this is one standard deviation. It's the same size. One standard deviation. Market gave us what? Two standard deviation. The third standard deviation. 1, 2, 3. The third what standard deviation. The fourth standard deviation before what this cell move. So market give us this what a little manipulation to the upside before this cell move. If you calculate it to the downside, the same thing with what we have one in what in price. 1, 2, 3. So we have also 3 standard deviation before what price bought to the upside for this what up move. So we have this what standard deviation before this what up move. We have this what 4 standard deviation and 3 standard deviation to the downside before this what up move. So we calculate the daily. We use this in calculating what some of the what daily range. So we have daily opening. We have Asian range. We have daily opening. We have Asian range. So most of the times I use this word Asian range. I don't use a central bank daily range most of the times. So we won't be adding it much. So if we'll be adding it, maybe as time goes on, the mentorship will be adding it. But for now, we'll not add it now. So we have this as a what Asian range. So we have daily opening. Same thing after the daily opening, you look for what your Asian range. You look for your what Asian range. So let's say this is what the daily opening. This is the time that the Asian range started. This place. This is the time that Asian range started. So the low within it to the high till 6 AM GMT plus 1 for London what opening. This is 6. So you use the body. You use the what? The body. So this is what the Asian range. This is the what Asian range. This is the what Asian range we use in determining what our daily range. This Asian range. Now let's say one standard deviation to the downside, since let's say now the manipulation happening for the week to calculate this what weekly range. Now let's say this the pip range is up to, if it's more than 30 pips, then now it's more than 30 pips, then you don't use it to calculate manipulation. Once it's more than what 30 pips, you don't use it. Once it's more than what 30 pips. So 1, 2, Market has given us up to what? To standard deviation 3, not up to 3, but at least 2.5 before this what little buy move that is happening now. But we are still what on down structure. We are still what on down trend. We are still what on down trend around this area. We are still what on down trend. We are still what in down trend. So that is that. This is what we call Asian range. The range. You use it what you note your Asian range. You note your what your daily opening. Your daily opening. The opening of the what the day. The opening of the week. This is today's opening, which is uh the time that market open this week also is daily opening, Monday opening, is also weekly opening. So Friday is Friday close, the closing of what Friday and opening of what Monday. So Sunday morning, Sunday evening in this side. So that is that. We use it in what part of the confidence we use in trading. Same thing how applies to what Thursday. This is a Thursday opening. This is Thursday opening. Then you calculate your Asian range after the Asian range before the sell move. Let's say Asian range start from here. So here, this place. So this is your Asian range, the low and the high. So this is your what Asian range. This is your what Asian range. This is your Asian range. This is what daily opening. So this is Thursday opening. This is Friday opening. This is Monday opening plus Asian range plus what Asian range plus the what Asian range. So that is that. We use them in line with structure. We use them what in line with what we structure and what our vehicle. We use them in line with structure and our what vehicle. So we use them what body to body, not week to week. We use them body to what body. We use them body to what body. We use them what body to what body. So this is for that. Now on H4 we have what we call weekly opening. Weekly opening. We have what we call weekly opening. Let's say for last week it opened on what on first. Now on first of last week should be what around this area. On first of last week should be here. It opened on this what particular candle. So from that to this is what a week. So this is what a week. Same thing from this to on 23rd. This is what a week. So this is a week. This is a week. This is a week. So you note your weekly opening, the opening of the what the week. You note what the opening of what the week, which is this area. You note what the opening of the what of the week. You note what the opening of the week. Yeah, let's come. So you note the opening of the what of the week. You note the opening of the week. Same thing applies to this what the opening of this week. So you note each day opening. you know each day opening. Know the opening of this week, you know the opening of this week. So we also have what we call monthly opening. So for this month is the same on first. It's the same this on first. So for the previous month, month, uh, which is February. So it's still what on first of what February, which is this area. So this is the opening of what a month. From here, from this point, from this place to this place is what a month. So you note your what monthly what opening, the monthly opening, the monthly opening. You note it, you note it, you note it. So this monthly opening, it gives us what idea of our what monthly range, idea of what our monthly range. So basically, they are what we call swing trading for Asian session swing trading, Asian session day trading, intraday, and position trading. But mostly, what we use is what Asian session to just to determine what the weekly view. So that is the one that we learned today. So when we'll be using our weekly and monthly for swing trading, we teach about that. We teach about that. But if we won't use it, then there's no need of what taking it. That is that. So we have our weekly what opening, we have our monthly opening, we have our daily opening, and we have what the closing price. We have the closing price. So that is that about what about price. That is that about price. Now you know if market is trending, let's say market is trending to the upside. Now market is trending to the upside. If market opens, this is the opening of the market. Now most of the times you to manipulate little to the downside. To the downside. Then after that, before it continue the what? The up move. That this manipulation most of the times it always uses to what to absorb what Asian session. After that, it will give us what? A true movement. After the true movement, within London and what New York session, it will go into consolidation again to close. So this one will become what the high of the day, the low of the day, the opening, and the what the closing price. So this is what C, which is the closing, O as the what opening, high as H, then L as the low of the day. In what a bullish candle. Same thing applies to what a bearish candle. If market is what totally what bearish, market will open after opening, you will have what a little manipulation to the upside as what the high of the day. Then man give us a true move to the downside. This is what a little manipulation to the upside as what high of the day, the opening of the what the day. Then after that, it will give us what a true move, go into consolidation later, then close. So this become what the low of the day. This become the what the closing of what the day. So most of the things you note your what your daily low and your daily high. You note your what daily low based on what the time frame you're trading. Mostly 15 minutes time frame or 5 minutes time frame. Mostly 15 minutes time frame or 5 minutes time frame. So you note your what even on what monthly opening and weekly opening and weekly close and monthly close. We use this um three time frame, which is monthly, weekly, and daily. We use their opening and the closing of them to what to give some what the range of each day. So we use them. So so that is that. That is that. So so now if you will have anything to do now, is what you being able to what you mark your daily opening, the daily high, the daily low, your previous day low. We have what we call previous day low. We have the daily opening, the time that market open, which is around this area for the previous day, which is on Friday. And we have the high of that Friday, which is this high. We have the high for that last week. Friday, this is the high of Friday. This is the high of that week. The high of that what of that week. This is the high. Now this is the low of that what of that week. Market has swept below the low of that what of that previous week. Of that previous week. Now since market has swept below it, now if market is about what to go bullish, now that means what since it has what a grab liquidity on the downside for that previous week, grab the low of that previous week, so market can easily what give us what a bullish run that what will be setting for what the other opposite high. It has taken the low of previous week. Now since it has taken the low, at least it need to what go and grab what liquidity within the what the range before giving us what a sweep down based on what the true weekly range, based on what true weekly range. So we'll be learning about mostly what we'll be learning is what we call daily range. Daily range, market structure, some aspect where we use what Wyckoff. So mostly where we use Wyckoff is for the corrective wave. We don't use Wyckoff in what a trended environment. What to join the trend, we use Wyckoff. We use Wyckoff in joining what the trend. Now, when we are done with that, then we use what Wyckoff cycle in explaining what the corrective wave. If the corrective wave is done for price to what to start selling, then we use what we call Wyckoff cycle only in the corrective wave, not determine the whole move. So market structure will be the one to tell us the whole move or the former range with supply and demand. With supply and demand based on what volume. We define supply and demand based on what volume. Based on what volume. So if we are learning volume, now this was the demand A zone that we use for our last previous week commentary or overview. We use this area as our what as our zone. We use in taking this what sell move. So initially in our weekly commentary, in that previous week commentary, we also have what we call a breaker around this area. We have a weekly breaker, but we checked between that weekly commentary. We saw that market has not yet tested this what supply zone. Market has not yet tested this supply zone, and market has been ranging. So we expect market to what grab this what supply zone, then target the what external liquidity, which is this low in the what consolidation range or the redistribution. After that, market what went down. Market went down. So that is that. So today, mostly what we talked about is what we call weekly opening, our monthly opening. Let's talk about monthly opening. You can use this is monthly high, the candle high of that month, the candle low of that month. That is monthly high and monthly low. Weekly high, the high of that, the weekly candle high and weekly candle low. We use it as what the fracture high of that what month. So we have your daily high and daily low, the previous day high and the previous day low. So that is that. So we're able to talk about your weekly opening, then daily opening, the Asia range, the high of the day and the low of the day. These are the things we discussed today. These are the things that we discussed today. These are the main things that we discussed today. These are the main things we discussed today. So try to what backtest. Now the assignment that we give now is what backtest what we call the weekly opening, the daily opening, then the high of the day, how price is reacting with the high and the low of the day. Backtest it. Then also backtest our what? London manipulation. London manipulation is been what is my own what understanding. It wasn't being taught by anyone. So I was able to what backtest it and see how price reacted. So what I learned from ICT is what we call key zone. He used key zone. He added what they put the London manipulation and all as what key zone. But I was able to differentiate it that there's what a manipulation that always happen before the what main kill zone happen. So backtest that London manipulation, New York manipulation, which is 1 hour interval before the what the main kill zone. Backtest how price react with them. Backtest the what the daily high, how price react with daily high and daily low. Backtesting will what help you a lot. Once you're able to backtest, as you are backtesting, you'll be learning new things apart from what I taught you or apart from what we have learned now, you will learn what some new things. So try so well to what backtest those things. Try so well to what backtest those things. So that is just it. That is just it. So that is that for today class. That is that for today class. As I said before, mostly this month is mostly what introduction. The things that you're supposed to know before joining the mentorship. That is what we are what teaching in this first month. Then after when we are done with this, then we teach what our vehicle cycle. When we are teaching vehicle cycle, we teach it as what even we use all time frame in explaining it. When we are done explaining it with all time frame, then before we teach what normal market structure. When we are done with teaching normal market structure, that thing that we learned with all time frame, we will not use it in all time frame again. You can even what spot it with your eye, even without trying to name it as Wyckoff pattern. You can even spot it with your eyes. Then you trade it in line with structure. You trade it in line with structure, just to know that what if the corrective wave is done, so that you what they take the impulsive wave. So that is just the reason why we use it. It's not that we use it to what confirm or take entry in that what Wyckoff cycle. We don't use Wyckoff cycle to take entry. What we mostly use to take entry is what supply and demand. Is what basically what supply and demand. So that is just that. So enjoy your day and have a good day as what we mix everything for what our own good. So also happy new week. Have a great day. Take care.